One weekend in September 2008, the titans of Wall Street gathered in a crisis meeting. Treasury Secretary Hank Paulson opened with 6 cold words that shocked everyone present. He said there would be no public money to support Lehman Brothers this time around. By Monday morning, a 158-year-old institution worth $639 billion in assets filed for bankruptcy. It remains the largest corporate collapse in American history to this very day. What followed erased $10 trillion from global stock markets within weeks. This is the story of hubris, greed, and a single weekend that broke global finance forever. The Lehman saga begins not on Wall Street, but in Montgomery, Alabama, back in 1844. Henry Lehman, a German immigrant, opened a modest dry goods store selling basic merchandise to locals. His brothers Emanuel and Mayer joined him, and by 1850, they renamed it Lehman Brothers. Cotton was king in the American South, and the Lehmans saw golden opportunity everywhere. They accepted cotton as payment and pivoted hard into trading this valuable commodity. When Henry died in 1855, the surviving brothers moved operations to New York City in 1858. From cotton traders, they evolved into one of the world's most influential investment banks. By the early 20th century, Lehman focused on public offerings and underwriting securities. Through the Great Depression, world wars, and market crashes, this firm survived everything for 158 years. Fast forward to 2006, and Lehman Brothers sat as America's 4th largest investment bank. In February 2007, its stock traded at $86 per share with market cap near $60 billion. CEO Richard Fuld had led the firm since 1994, the longest tenured chief on Wall Street. Fuld was a trader's trader who inspired fierce loyalty, but also cultivated an intimidating culture. His board included retired CEOs from Vodafone and IBM who rarely challenged his decisions. Inside Lehman, questioning the boss could be career suicide, a fatal cultural flaw revealed later. The housing boom of the early 2000s created a monster that would devour Wall Street whole. Banks packaged subprime mortgages, loans to weak borrowers, into complex securities called CDOs. These collateralized debt obligations spread toxic risk across the entire global financial system quietly. By 2006, subprime bonds dominated CDO issuance as dealers pushed them on a massive scale. 2/3 of these structured products were issued in 2006 and 2007 alone. Banks earned fat fees packaging and selling these instruments without understanding real risks beneath the surface. Lehman dove deep into this market, building enormous positions in mortgage-backed securities. Fuld was praised initially for navigating the early subprime crisis better than most rivals. But he underestimated how badly the housing downturn would hurt Lehman's mortgage bond business. By November 2006, housing permits had dropped 28% compared to the previous year across America. Interest rate hikes triggered defaults as borrowers with adjustable loans could not afford rising payments. The dominoes were beginning to fall, but Wall Street kept dancing to the music playing. March 2008 brought the first major casualty when Bear Stearns nearly collapsed under subprime losses. The government arranged an emergency sale to JP Morgan Chase at just $10 per share. Bear's stock had traded at $170 a year earlier, meaning 94% of value was destroyed overnight. The Federal Reserve provided $29 billion in assistance to make the JP Morgan deal work smoothly. This bailout sent a crucial signal to markets that the government would rescue failing financial giants. If Bear Stearns was too big to fail, surely Lehman Brothers would get saved too, right? That assumption proved catastrophically wrong, and here is where the real story begins unfolding. Throughout 2008, Lehman reported massive losses as its mortgage holdings deteriorated month after month. The stock lost 3/4 of its value, and talks with Korea Development Bank collapsed. Behind the scenes, Lehman played a dangerous accounting game called Repo 105 to hide troubles. This technique temporarily removed toxic assets from the balance sheet right before quarterly reports. Lehman recorded these transactions as sales when they were actually just short-term secured loans. Under CFO Aaron Callan and CEO Richard Fould's direction, Lehman moved $100 billion off books. This made leverage ratios appear safer, falling from 13.9 to 12.1 on paper alone. Ernst & Young audited Lehman and approved these transactions without adequately challenging their purpose. The manipulation portrayed a completely misleading picture of the bank's true financial position. Investors, board members, and rating agencies all received false confidence from manipulated numbers quarterly. When truth emerged, it would destroy whatever trust remained in Lehman Brothers completely. September 2008 arrived like a gathering storm, darkening Wall Street's already clouded skies dramatically. On September 7th, the government seized mortgage giants Fannie Mae and Freddie Mac into conservatorship. The housing crisis had now claimed two of America's largest financial institutions in a single weekend. Lehman stock continued its death spiral as clients fled and counterparties grew increasingly nervous. By Thursday, September 11th, the firm was experiencing what executives called a good old-fashioned bank run. It had lost 70% of its value since Monday's opening bell, bleeding out in public view. That evening, Treasury Secretary Hank Paulson called Bob Diamond, CEO of Britain's Barclays Bank. Paulson asked if Barclays would be interested in buying Lehman Brothers at any price whatsoever. Diamond expressed interest but needed government assistance similar to what J.P. Morgan received for Bear Stearns. Friday evening, September 12th, Paulson summoned Wall Street's most powerful executives to the New York Fed. The heads of Goldman Sachs, Morgan Stanley, Merrill Lynch, and others received urgent summons. They gathered in crisis mode, understanding that the fate of global finance hung in balance. Paulson delivered his bombshell announcement that no government money would rescue Lehman this time. Not a penny, Fed officials emphasized to the stunned room of billionaires and banking titans. The assembled executives were instructed to develop a private sector solution by Monday morning. All weekend, frantic negotiations continued inside the Fed's fortress-like headquarters in Lower Manhattan. Barclays remained interested, and Bank of America also circled as a potential white knight buyer. But both suitors wanted government guarantees that Washington stubbornly refused to provide now. Bank of America pivoted away from Lehman and quietly negotiated to buy Merrill Lynch instead. That deal closed at $50 billion, saving Merrill while leaving Lehman completely exposed and alone. Barclays needed British regulator approval for guarantees, and London refused to back American toxic assets. Sunday evening, September 14th, reality set in like a cold blade through Lehman's heart. No buyer would emerge, no government bailout was coming, and bankruptcy became absolutely inevitable now. Harvey Miller, Lehman's bankruptcy counsel, prepared the largest Chapter 11 filing in American history. At 1:45 a.m. on Monday, September 15th, 2008, Lehman Brothers filed for bankruptcy protection officially. The filing covered more than $600 billion in assets, dwarfing Enron's previous record immediately. A 158-year-old institution that survived the Civil War and Great Depression was gone overnight. Markets opened Monday morning and immediately collapsed into chaos across the entire globe. The Dow Jones plunged 504 points, or 4.42%. Its worst single-day decline in 7 years. Investors fled from Goldman Sachs and Morgan Stanley, fearing they would fall next in sequence. American International Group, the giant insurer, saw its stock crash 61% on Monday alone. AIG had sold billions in credit default swaps, guaranteeing the mortgage securities now turning toxic. The next day, September 16th, the Federal Reserve provided AIG an $85 billion emergency loan. The irony was bitter and infuriating to those watching events unfold across trading floors worldwide. Lehman was denied help on Sunday, but AIG received a massive bailout barely 24 hours later. The inconsistency confused markets and destroyed confidence in how regulators would respond to crises. Credit markets froze completely as banks stopped lending to each other out of pure fear. Lehman had been a major issuer of commercial paper, short-term debt that greased daily commerce. Its collapse caused a credit freeze that rippled through businesses and consumers worldwide immediately. On September 18th, Treasury Secretary Paulson and Fed Chair Ben Bernanke met congressional leaders urgently. Bernanke warned that the credit markets were approaching complete meltdown without massive government intervention. He reportedly told Speaker Nancy Pelosi, "If we don't do this, we may not have an economy on Monday." Congress debated furiously as the crisis deepened through late September into early October 2008. On October 3rd, the Troubled Asset Relief Program, known as TARP, became law with $700 billion authorized. This fund would inject capital into struggling banks and purchase their toxic mortgage assets directly. The damage was already catastrophic, spreading far beyond Wall Street into every corner of America. 26,000 Lehman employees worldwide lost their jobs when the firm collapsed that Monday. Their retirement accounts, heavily invested in Lehman stock, evaporated alongside their employment immediately. By March 2009, the Dow Jones had plummeted to 6,594, a decline exceeding 50% from 2007 peaks. Unemployment eventually hit 10% as businesses across America laid off workers in survival mode. General Motors and Chrysler both filed for bankruptcy in 2009, requiring additional government bailouts. Global markets suffered approximately $10 trillion in losses from the financial crisis overall. European and Asian banks holding American mortgage securities faced their own capital crises immediately. The ripple effects created what became known as the Great Recession, the worst since 1929. What killed Lehman Brothers? The autopsy reveals multiple fatal wounds inflicted over several years. Excessive leverage amplified gains during good times, but magnified losses when markets turned violently. At its peak, Lehman held $639 billion in assets against just $619 billion in debts. The Repo 105 accounting manipulation obscured real risks from investors, regulators, and even board members. Ernst & Young failed to challenge these questionable practices adequately despite clear warning signs everywhere. This auditor failure echoed Arthur Andersen's complicity in Enron's collapse just 7 years earlier. Richard Fuld's leadership style prevented honest assessments of mounting dangers facing the firm directly. He ignored warnings from credible sources that subprime investments were creating a financial house of cards. His board of prestigious but passive directors failed to challenge his increasingly risky strategies decisively. The government's inconsistent response created fatal confusion at the worst possible moment imaginable. Bear Stearns received help in March, setting expectations that Lehman would get saved too. When bailout was denied, Lehman was completely unprepared for bankruptcy, making the filing chaotic. Years later, Fuld still blamed everyone except himself for the disaster his firm created. He pointed to lax regulations, irresponsible consumers, and government policies that encouraged homeownership recklessly. In 2015, he told audiences that Lehman was not a bankrupt company when it filed. The Financial Crisis Inquiry Commission found otherwise, citing failures at every level of the system. Banks created risky products, regulators failed to supervise them, and rating agencies blessed toxic securities. The inconsistent treatment of Bear Stearns versus Lehman Brothers worsened market panic significantly. Lehman's collapse fundamentally changed how governments approach financial institutions now deemed systemically important. The Dodd-Frank Act of 2010 created new oversight mechanisms for large financial companies directly. Banks now face stricter capital requirements and undergo regular stress tests against crisis scenarios. The too big to fail doctrine emerged as central debate in financial regulation after September 2008. Some argue government should always rescue systemically important institutions to prevent economic catastrophe spreading. Others insist moral hazard means bailouts encourage reckless behavior that creates future crises inevitably. 16 years later, Lehman remains a powerful symbol of what unchecked greed can destroy overnight. A single weekend of failed negotiations and political calculations erased 158 years of history completely. The shockwaves reshaped banking, regulation, and public trust in financial institutions fundamentally. Remember this when markets seem invincible and experts dismiss warning signs as pessimistic noise. Bear Stearns executives thought they were safe until the weekend their firm was sold for pennies. Lehman traders believed government would never let them fail until that final, fatal Sunday night. The lesson echoes through every earnings report and credit rating issued on Wall Street today. Complexity can hide risk, leverage can kill quickly, and confidence can evaporate in mere hours overnight. One weekend really did break global finance, and we are still living with consequences now.